Most investors look at a 10% dividend yield and see a golden opportunity. But in the world of professional investing, a yield that high is often a distress signal, a siren song that leads straight into a capital-destroying trap. Today, we are moving beyond simple yield chasing. We are diving into the ChartMill blueprint for strategic dividend growth investing. This isn't just about income. It's a total return strategy focused on companies that have the financial strength to raise their dividends year after year through every market cycle. We're going to walk through the exact professional framework for identifying these elite businesses, seeing through accounting illusions using free cash flow, and using the interest coverage ratio as a shield to protect your capital from debt traps. Before we touch the screener, we have to understand the math. Why do we prioritize growth over a high starting yield? Let's compare two $10,000 investments over a 20-year horizon. Stock A is a high starter with a 5% yield, but slow 2% annual growth. Stock B starts lower with a 3% yield, but strong 8% annual growth. In year one, Stock A gives you $500, while Stock B gives you only $300. Most retail investors would stop there and pick Stock A. But look at year 10. This is the crossover point. Both stocks are now paying you roughly $600 per year, or a 6% yield on cost. By year 20, the difference is staggering. Stock A's yield on cost has only crawled to 7.3%, but Stock B, the grower, is paying you 13.0% on your original investment. This is the power of the dividend magnet. Historically, a stock's price tracks its dividend growth. If the dividend grows fourfold, the share price usually follows, giving you both massive income and capital gains. To build this portfolio, we start with a hierarchy of quality. Dividend kings. These companies have increased dividends for 50-plus consecutive years. They are recession-proof payers that have survived everything from the '87 crash to the global pandemic. Dividend aristocrats, 25-plus years of growth, and part of the S&P 500. These offer elite consistency and index-level liquidity. Dividend challengers, 5 to 24 years. These are the emerging compounders where you often find the highest growth potential. ChartMill allows us to filter for these tiers directly to ensure we are only looking at businesses with a proven culture of rewarding shareholders. Section 3 of the blueprint outlines the metrics that matter. First is the dividend growth rate, DGR. We target a 5-year CAGR of 7% to 10% for our core positions to ensure we are outperforming inflation. Second is the dividend payout ratio. But be careful, there are two ways to measure this. Earnings payout. This uses accounting profits, net income. We generally want this below 60% for most sectors. FCF payout. This is the gold standard. Dividends are paid from cold, hard cash, not accounting profits. Look at Novo Nordisk in 2025. On paper, their payout ratio was a safe 50.5%. But when we look at free cash flow, their payout ratio was a dangerous 188%. Why? Because they were spending billions on new factories, CapEx. This is why you must always verify cash flow coverage. A company can look perfect on paper while its bank account is empty. Now we are moving into the professional tier of analysis. Most retail investors stop at free cash flow, but to truly understand if a dividend is sustainable, especially in tech and media, we have to look at stock-based compensation. SBC is a non-cash expense that companies add back when they calculate their official operating cash flow. But make no mistake, SBC is a very real cost to you, the shareholder, because it dilutes your ownership. If a company pays a dividend but issues millions of new shares to its employees, that raw FCF number is actually overstating the cash that is truly available to you. Let's use the Comcast example from the ChartMill blueprint to see how this works. In 2025, Comcast reported a massive free cash flow of $19.235 billion. On the surface, that looks incredible. But when we look at their cash flow statement, we see they also issued $1.288 billion in stock-based compensation. To get the true cash, we subtract that SBC from the FCF. Adjusted FCF equals $19.235 billion, reported, minus $1.288 billion, equals $17.947 billion. Now, if we look at their dividend payout of $4.894 billion, the adjusted FCF payout ratio is 27.3%. Without this adjustment, it would have looked even lower at 25.4%. While Comcast is still very safe, this 2% difference represents over $1 billion of cash that is being spent on dilution rather than being available for your dividends. But wait, dividends are often only half the story. To see the bigger picture, professional investors look at the total payout ratio. High-quality companies often use buybacks alongside dividends to return capital. Look at Comcast again. In addition to their dividends, they had net buybacks of $7.160 billion. Total capital return, dividends plus buybacks, equals $12.054 billion. When we divide that by our adjusted FCF, $17.947 billion, we get a total payout ratio of 67.2%. So, while the official dividend payout is a very safe 27%, Comcast is actually returning nearly 68% of its available cash to shareholders. Why does this matter? Because buybacks create breathing room. By reducing the total number of outstanding shares, Comcast lowers the total amount of money it has to pay in dividends in the future. This makes it much easier for them to keep raising the dividend per share for the next decade without putting extra strain on their cash flow. The golden rule from the blueprint is simple. A company that is aggressively reducing its share count is often providing the ultimate safety net for your future dividend raises. Section 5 of the blueprint outlines the 5-step ChartMill workflow for finding foundation stocks. Step 1. The initial screen. We run 5 filters in ChartMill to find our candidates. Dividend growth, 10 plus years. Industry yield, rank greater than 50. Dividend rating, greater than 6/10. Market cap, greater than $2 billion. Interest coverage, greater than 3.0. Step 2. Sector context, the reality check. Compare the payout to industry benchmarks. A 65% payout is a green flag for a utility, but a red flag for a software company. Step 3. The cash flow safety check, FCF payout. Go to the ChartMill cash flow statement. Divide dividends paid by free cash flow. If the FCF doesn't cover the dividend, the stock fails the test. Step 4. The adjusted payout ratio, SBC adjustment. Find the share-based compensation in the 10K or cash flow statement. Subtract it from the FCF to get your adjusted FCF and recalculate the payout. We want to see that dilution isn't eating your dividends lunch. Step 5. Evaluate total capital return. Check the purchase/sale of common stock line to include buybacks. Use the formula, dividends plus net buybacks, divided by adjusted FCF to get your total payout ratio. This tells you exactly how much excess cash is actually returning to you. Beyond the foundation screen, the blueprint provides 2 alternative strategies depending on your goals. The Yield Stalwarts screen. This is for investors targeting immediate income from large cap stability. Filters. Dividend non-decrease, greater than 15 years. Yield greater than 3.5%. Yield industry rank greater than 75. Interest coverage greater than 3.0. Standard payout less than 75%. And market cap greater than $5 billion. The Growth Compounder screen. This is for long-term payout growth, prioritizing a high CAGR over current yield. Filters. Dividend yield, 1.0% to 2.5%. Dividend growth, 5 years, greater than 12%. Interest coverage ratio, greater than 3.0. Standard payout ratio, less than 45%. EPS growth, next 5 years, greater than 5%. Market cap, greater than $2 billion. Why do we use interest coverage as a shield? Look at Walgreens. For 47 years, they were a dividend aristocrat. But in 2023, their yield hit 9% because the stock price cratered under a mountain of debt. Their interest coverage ratio dropped below 2.0 times. When operating income can barely cover interest, the dividend is always the first thing to go. Walgreens was forced to slash its dividend by 48% in 2024. Never ignore the debt trap. If you want to perform the deep dives we discussed running these advanced screens, I highly recommend the trial offer. It gives you full, unlimited access to ChartMill for 1 entire month. This allows you to build your complete high-quality watch list without any restrictions. Check the link in the description to start your trial and put this blueprint into action. Thanks for watching and happy investing.